22.6% in a single trading session, a number so large that the quantitative models underpinning Wall Street in 1987 classified it as a statistical impossibility, an event that should not occur once in the lifetime of the observable universe. What followed was not another Great Depression, and the margin between those two outcomes was, in the end, a single sentence. 14 words issued before the market opened on October 20th. 10 days before the crash, a signal had already been sent. Almost no one read it. This episode is about how a financial system comes within hours of total failure, and then, improbably, does not. It is also about whether that outcome was the product of preparation or luck, and whether the distinction matters. About 30 minutes in, we'll reach the specific document that Ben Bernanke later identified as a model for crisis communication. A single-sentence Federal Reserve statement so spare it barely fills one line of type. Whether it saved the American financial system, or whether something else did, something that happened in Chicago in the early hours of that same morning, involving a Midwestern bank whose name most people have never heard, is the question this episode is built around. We begin not on October 19th, but 10 days earlier. To understand what broke on October 19th, 1987, you need to understand what had been building for 5 years, and why almost no one with money on the line saw it coming. The Dow Jones Industrial Average had risen from roughly 800 points in late 1982 to a peak of 2,722 in August 1987, a gain of more than 240% in under 5 years. By the autumn of that year, the price-to-earnings ratio of the S&P 500 had stretched to levels not seen since the late 1920s. The bull market had survived tax reform, Iran-Contra, and 2 rounds of modest Federal Reserve tightening. It had, as bull markets tend to do, begun to feel like a permanent condition of the universe. Then the cracks appeared. Through September and into early October 1987, the market sold off steadily. A rising trade deficit reported in mid-October spooked bond investors. Long-term Treasury yields, which had been climbing since the spring, crossed 9%. The dollar was under pressure. On October 14th, 15th, and 16th, the Dow fell a combined 9.5% across 3 days, already a historically severe move. Most observers described it as a correction. The word they reached for was healthy. Nobody called it a warning. The first and most technically detailed explanation for what happened on October 19th centers on a financial innovation that barely existed 3 years earlier: portfolio insurance. The name alone should have given someone pause. In about 3 minutes, we'll look at the specific sell order, the size, the timing, the exchange it hit, that turned a bad morning into a historic collapse. Portfolio insurance was a strategy developed principally by Hayne Leland and Mark Rubenstein, 2 economists at the University of California, Berkeley, who founded Leland O'Brien Rubenstein Associates in 1981. The theory was elegant. By systematically selling stock index futures as the market fell, an institutional investor could synthetically replicate the payoff of a put option, a floor beneath their losses. In a rising market, you held your equities. As prices declined, you sold futures. The model told you exactly how much to sell at each price level. It was, on paper, foolproof. By October 1987, somewhere between $60 billion and $90 billion in institutional assets, pension funds, insurance companies, endowments across the country were being managed under portfolio insurance strategies. Each of them had been sold a safety guarantee that rested on one critical assumption: that the futures markets would remain liquid enough to absorb the selling precisely when it was most needed. On the morning of October 19th, that assumption was tested immediately. The market opened sharply lower. Portfolio insurance models triggered sell orders. Those sell orders pushed futures prices down further. Lower futures prices triggered more sell orders. The feedback loop accelerated faster than any human being could interrupt it. The Brady Commission, The Presidential Task Force on Market Mechanisms, convened by Nicholas Brady in the immediate aftermath, which published its findings in January 1988, documented the cascade with granular precision. On October 19th alone, portfolio insurers sold an estimated $19 billion in futures contracts. The S&P 500 futures contract at one point in the afternoon traded at a 12% discount to the underlying cash index. The two markets, which are supposed to be mechanically linked by arbitrage, had effectively decoupled. The plumbing that held the equity market together had failed, and it had failed in public. Leland O'Brien Rubenstein had sold institutional America a parachute. What they had not modeled was what happens when every parachute in the plane opens at once. But portfolio insurance explains the mechanism of the collapse more than it explains the timing. For that, you have to look at the Federal Reserve and at the interest rate environment that the transition from Paul Volcker to his successor had quietly produced. Alan Greenspan had been confirmed as chairman of the Federal Reserve Board in August 1987, succeeding Paul Volcker, who had broken the back of double-digit inflation through the grinding rate hikes of the early 1980s. Greenspan inherited a Fed watching inflation nudge upward and a dollar weakening under the terms of the Louvre Accord, a G7 currency coordination agreement struck in February 1987, which bound the United States to defend the dollar's value through monetary tightening. It was a delicate arrangement. It was also about to be publicly undermined. What undermined it was a single sentence in a newspaper interview, and we'll read that sentence in full in about 4 minutes. The Fed raised rates in September 1987. Then, on October 6th, Treasury Secretary James Baker made a public statement suggesting the United States might allow the dollar to depreciate rather than raise rates further to defend the Louvre Agreement. The bond market sold off immediately. 10-year Treasury yields spiked. This was the interest rate signal, delivered publicly, inadvertently, 10 days before the crash, that this channel promised you at the start of this video. Baker's comment did not cause the crash by itself, but it told equity investors, in plain language, that the policy floor they had assumed was in place might not be there. In a market already priced for perfection, that was enough to start the avalanche. Robert Shiller, the Yale economist, surveyed both institutional and individual investors in the days immediately following Black Monday. His data, published in the Journal of Economic Perspectives in 1990, found that most investors cited no specific news item as the trigger. They cited the behavior of other investors. They were watching each other. The fundamental instability was not in that week's headlines. It was already embedded in the price level and had been for some time. The third line of explanation runs deeper than any single policy signal or any single financial instrument. It concerns the structure of the equity market itself in 1987, specifically the relationship between the New York Stock Exchange and the Chicago Mercantile Exchange, which had become functionally inseparable and functionally ungovernable through the growth of index futures. Index futures on the S&P 500 had been trading at the CME since 1982. By 1987, the daily dollar volume in S&P futures regularly exceeded the dollar volume of stock trading on the NYSE, a derivative's tail wagging an equity dog that no regulatory framework had anticipated. The SEC governed the NYSE. The CFTC governed the CME. The two regulators shared no common communication protocol, no common circuit breaker rule, no common closing time. On October 19th, the NYSE's designated order turnaround system, the automated order routing mechanism known as DOT, became so overwhelmed that many market makers simply stopped answering their phones. Trading in dozens of major stocks was halted intermittently throughout the afternoon. The S&P futures continued to trade in Chicago regardless. Up to this point, every account of Black Monday treats the crash as a market failure. What comes next is where those accounts begin to disagree, and where the history becomes genuinely unsettled. Because what happened after October 19th was not what the models predicted, the market did not keep falling. And the reason it didn't, the exact mechanism that broke the momentum of a historic collapse, is the part of this story that has never been fully settled. By the close of trading on October 19th, the Dow Jones had fallen 508 points, 22.6% in a single session. The financial press used words like carnage and collapse. Economists who remembered 1929 began making careful private comparisons. At least two major brokerage firms faced potential insolvency. The clearing system for derivatives trades had come within hours of a technical failure that would have frozen settlement across the entire equity derivatives complex. The system had not broken, but it had bent further than anyone had believed possible. Alan Greenspan was on a plane to Dallas for a speaking engagement when the market opened on October 19th. He was in the air when the worst of the selling occurred. He landed, received the news, and on the morning of October 20th, the Federal Reserve issued a statement 11 words long. It read, "The Federal Reserve, consistent with its responsibilities as the nation's central bank, affirmed today its readiness to serve as a source of liquidity to support the economic and financial system." What that statement did not say, the specific condition it deliberately left unnamed, is the detail that kept several large brokerages open the following morning, and we'll reach it near the end of this video. One sentence, 11 words of substance. No dollar amount, no mechanism, no specific facility announced. But the signal was understood immediately by every bank president and every money market desk in New York. The Fed would not allow a liquidity crisis to become a solvency crisis. It would lend. It would lend as much as was needed. It would not repeat the central bank passivity of 1930 and 1931 that Charles Kindleberger had diagnosed in his landmark 1978 study, Manias, Panics, and Crashes, as the proximate cause of the Depression's depth. Simultaneously, and this is less well remembered, the Fed's senior staff made direct phone calls to the major New York banks, asking them to continue extending credit to their broker-dealer clients. Not ordering, asking. Gerald Corrigan, then president of the Federal Reserve Bank of New York, was the principal figure in those calls. His argument was straightforward. If the brokers failed, the bank's own collateral positions would be worthless. Self-interest and systemic stability were, for once, perfectly aligned. The market opened on October 20th in chaos. There was a second frightening plunge in the first hours of trading. Then, just before noon, the major market index futures contract, a proxy for the Dow traded in Chicago, began to rise. 20 of its 21 constituent stocks moved up simultaneously. To traders watching the screens, it looked like a coordinated intervention. The SEC later concluded it was not. It was, more prosaically, a cluster of buy orders from firms that saw the futures discount as an arbitrage opportunity. But at the moment it happened, it worked as a signal. The selling stopped. The market closed up on October 20th. If you had been told on the evening of October 19th that the recovery would begin within 18 hours, you would not have believed it. The system held, by one sentence, by a handful of phone calls, by a cluster of arbitrage orders that no one had coordinated. The next episode in this series covers the institution that came closest to not surviving that morning, and the internal memo, dated October 20th, that its own board never made public. Here, then, is the line. Near the start of this episode, I promised you a specific Fed signal from 10 days before the crash, and we reached it in Act 2, Baker's dollar statement on October 6, 1987. But the more historically significant signal was the one that came after, that single-sentence statement on the morning of October 20th. Whether what followed constitutes genuine policy mastery or a narrowly avoided accident is the question the historical record has never fully resolved. The case for mastery rests on the speed and clarity of Greenspan's signal. The 1930 Fed had the same tools and did not use them. The 1987 Fed used them within 14 hours. Ben Bernanke, whose academic career was built in part on studying the credit contraction of 1929 through 1933, later described Greenspan's October 20th statement as a model for crisis communication, the minimum commitment necessary to arrest a panic without committing to specific support for specific institutions. The case for accident is harder to dismiss. The Brady Commission's 1988 report found that the clearing system for equity derivatives had come within 2 hours of a cascading failure on October 20th. Had the CME's Clearing Corporation not received an emergency credit line from Continental Illinois Bank in the early hours of October 20th, the futures market might not have opened that morning. The policy signal was necessary. It may not have been sufficient. What held the system together, in the end, may have been a credit line from a Midwestern bank that nobody outside the industry remembers. The crash of 1987 produced the circuit breaker rules that govern equity markets to this day. Automatic trading halts triggered when the Dow falls 7, 13, or 20%. It produced the first serious interagency coordination between the SEC and the CFTC. And it produced, in the minds of a generation of central bankers, a template. Move fast, signal clearly, preserve liquidity, and ask questions later. Whether that template represents wisdom or mere luck, whether Greenspan's 14 hours of response time was the product of intellectual preparation or fortune, is the question the historical record has declined to answer definitively. What it has settled is this: the crash of 1987 did not become the depression of 1988. And the margin between those two outcomes, measured in Continental Illinois credit lines and one-sentence Federal Reserve statements, was narrower than anyone who survived, it has been comfortable admitting. If this got you, the next episode on this channel is about the collapse of the European exchange rate mechanism in September 1992, the week a single currency peg broke and took Britain's post-war monetary strategy with it.